Today, we are presenting how are credit scores calculated. Let's take a look at that big mystery. We will begin with the biggest chunk of the pie, and that is your credit history. Obviously, it makes sense that the way that you pay your bills would have an effect on your credit score. That makes up about 35% of your total credit history. But do keep in mind that certain things will make a bigger impact on that slice of the pie. Things like bankruptcies and judgments and collections will have a pretty big impact. The next big slice of the pie is how much you owe. There is a large emphasis placed on the amount of credit available to you. That means a comparison of the amounts that you owe compared to the amounts of credit available. For example, person A has a total of $50,000 worth of lines of credit on credit cards. However, his balances total $45,000. That means that they only have $5,000 of available credit, or 10% of their credit. Person B has $20,000 worth of line of credit, but they only owe $5,000. That means that they have 75% of their credit available, and therefore the credit bureaus would rate them more favorably than person A. The next section here is going to be the length of your credit history. This is how long you have had your accounts established. Many times, older people who have had good credit history will have much better credit scores than someone who is younger and has had good credit history as well. And that is simply because they have demonstrated their ability to manage their credit over a much longer period of time. This is also where the age of a collection account comes into play and how it can affect your credit. If you haven't heard by now, paying off collection accounts can initially lower your credit score. Why is that? Well, because when you first pay off that credit account, collection account, you are now going to have a brand new date for the rating, making it something that is no longer seasoned. So if you do have a collection account, make sure that you consult with your loan officer before you do anything with it. You don't want to have your credit score lowered because you decided to pay off that collection. Next comes the type of credit that you are using. Like with many other things, variety is a good thing. The credit bureaus have a model in which they look at the mix of credit that you have between installment, like mortgages, autos, student loans, that type of stuff, and revolving. So those are would be your credit cards and lines of credit. They want to see that you have a nice mix of both or of all the different types of credit, and that you are able to equally manage them all. And our last little slice of the pie is the age of the credit. Obviously, someone who has a lot of established accounts where they have shown their ability to repay is going to seem a lot more stable than someone who has just opened up accounts or has gone out and taken out a bunch of new loans or opened up a bunch of new credit cards. This is also where inquiries come into play, as the credit bureaus do take a look as to how much credit you have been applying for recently, and it can potentially lower your credit score. So keep those inquiries down to a minimum and don't go crazy opening up new accounts, and you should be okay. And so there you have it, the pie explained based on the current information available. If you have any specific questions about your credit history or would like to see what a mortgage credit report looks like for you, please feel free to contact me. I can always be reached for a free consultation. Thank you, and talk to you soon.